Welcome back to Lamb's Cryptoverse. Today I'm going to talk to you about inflation, what it is, and how long it's going to last. So let's go to the screen. First of all, what's inflation? Basically, that's a generally higher level prices over time. And there are many causes of inflation. This time it's coming from currency debasement. And I could show you lots of evidence of that. We can look at the Fed's balance sheet. Let me minimize myself, move myself over. This is the total assets of the Fed. And you can see it started rising rapidly during the GFC, Great Financial Crisis of 2007, 2008. But then it started rising rapidly again during the COVID crisis. And then you could see other evidence of that. Because when you have more assets on the Fed balance sheet, there's basically more money printing, literally. So then you can see here, this is the currency in circulation. And you could see how in 2020, it skyrocketed. And so did the NASDAQ, because the NASDAQ is correlated with currency in circulation. Speaking of correlation, so is Bitcoin. I've got data going back to 2019, and you can see that when the currency in circulation went up, so did Coinbase. And an interesting tidbit is that Cathie Wood stocks, basically exponential age stocks, growth stocks, they topped in February of 2021, and so did currency in circulation. Coincidence? I think not. And crypto and Bitcoin topped a month later, as you can see here in March. Now, as currency in circulation is declining, you see there's a lot of pressure. I don't need to tell you, there's a lot of pressure on growth stocks because they're declining. So what I want to talk to you about is the causes of inflation. This is a great schematic from Economics Help, and it talks about this demand pull inflation and cost push inflation. Unfortunately, we have both, and this is made before COVID, I think. This is made in December 2021. So it was made during COVID, but doesn't talk about it specifically. But COVID produced its own set of problems, right? We've got a whole sorts of issues with bottlenecks, of logistical bottlenecks, factories being closed in China, trade wars, and then we've got what we have here in the schematic. We've got cutting interest rates, increased money supply. Yep, we can check that. Devaluation, we can check that. Cost push inflation. Basically, not too many people know this. They talk about higher energy prices, but those higher energy prices were due to the decline in WTI oil futures prices to basically zero. The futures prices went to zero because there's overinvestment in the United States in terms of fracking, and those companies went bust. And what happened was oil prices went down, and those, like I said, those companies went bust, and so they became stricter, meaning they stopped spending money on capex to produce more energy in the future. And so that stoppage to capex way back in 2015-16 is what caused today's higher energy prices. And then what I want to focus on today is higher wages right here. Now the problem is that we have a services economy. As you know, 2/3 of GDP, US GDP is from services. That means wages. And I'm going to show you something specifically, and that's this. This is the average change in wages, percent change, versus unemployment rate. And you can see here, when unemployment rate goes up, wages go down, or vice versa. Because there's too much supply, it's like supply and demand. When there's a lot of supply of people that want to work, the weekly wages go down. That's what we need to see here. And we don't see that yet. We have a 3.5% unemployment rate, one of the lowest unemployment rates on record. And because of that, we have high wages. So the only way we're going to see lower inflation is if we get rid of the stickiness part of inflation, which is coming from wages. And the only way to get rid of wage inflation is to get that unemployment rate higher. This is why there's no Fed dual mandate. Remember, the Fed's mandates are two. They're one, to keep the unemployment rate low, and two, to keep inflation low. But they don't give a damn about the unemployment rate. They have no choice. The Fed was a year too late in tightening, so they lost control of inflation. So the only thing the Fed could do now is create lower or cause lower inflation so breaking the back of inflation by causing a recession. They have no choice whatsoever. So that's the problem, and that's going to take longer. But I think despite that, underlying inflation is actually low. It's probably around 3%. But the Fed needs to, like I said, they need to first get rid of this wage growth by causing a recession. So that's my key point today to you, is that it's this the services economy that's too strong and the unemployment rate is too low. So the Fed needs to cause a recession. Well, thank you all for listening. Please like us and subscribe to us. Bye-bye.